have with us Kalpesh Ashar of Full Circle Financial Planners and Advisors. Kalpesh, always a pleasure having you with us. Thanks so much for joining us today on The Money Show. So to start with, like I mentioned, the last 4-5 odd months, we've been seeing continuous net inflows into this whole corporate bond fund category. But to start with, corporate bonds in general, let's not look at the fund bit. Let's just look at the instrument as a whole. Why do you think investors are looking at corporate bonds in a bigger fashion? And for retail investors, we usually just invest in retail, in bank FDs or in government bonds, the RBI bonds, the new ones that have been issued. Do you think corporate bonds are an avenue as well worth looking at?
So Mubina, we've all been witnessing a very universal type of a falling interest rate scenario over the last 6 to 12 months. And it's no surprise that in spite of the pandemic, and as you rightly said in the beginning of the program, things have been a little bit on a contradictory way. So people, in spite of the gloomy atmospheres, are still searching for that extra alpha, that extra returns. And the bank FDs and the small savings schemes have completely gone down, the interest rates on that. And bank FDs now offer you a 5%. Small savings schemes also, which are still not bad, but still their interest rates compared to the earlier ones have gone down. And obviously, people are now looking for a little bit more of a greener pasture in the fixed income space also. So automatically, the focus shifts into the corporate bond category. And like you rightly said, people want that extra bit of an element of alpha in their fixed income also, which as a financial planner, I don't advocate, but we need to talk about it. So there are two ways in which people have approached it. Some people have approached it in the direct manner, and for investing in direct corporate bonds, I feel it is more suitable for HNIs and the savvy fixed income investors who have the wherewithal and the amenities to invest in direct corporate bonds, because it is not a simple thing as easy as going to a broker and buying some stock in equity. So it is it's some very select bond trading institutions help you out. And more importantly, the ticket size is quite large in buying corporate bonds directly. So the focus has been on corporate bonds, and for that extra bit of interest which they are offering over and above the conventional modes of fixed income investment. So here, the dilemma which is faced if you go to buy a corporate bond outside is that you cannot time the right time to purchase it if you're not savvy, or either to sell it, and even understand the interest rate fluctuations, which are very, very volatile in this existing scenario. So you might be caught on the wrong side of the curve and end up making a big mistake. Or if you're not savvy enough, even you might get into a wrong credit rated or a badly credit rated corporate FD, which is offering a higher yield, and again be caught on the wrong foot. So these type of things are best suitable for HNIs who have the complete wherewithal to invest in direct corporate bonds. So that is part one. And obviously the second thing which you said is the crux of what we are going to talk about is investing through the mutual fund route. The corporate bond funds have seen a lot of inflows in the last 3 to 4 months, and for various reasons as well. So first and foremost is the search for that extra alpha, but more importantly, the diversion from credit risk and all these accidents which we have seen in the last 3-4 months have diverted the money to corporate bond funds. And as we all know, in the mutual fund space, the mandate is that it should be AA plus rated. More than 80% of your scheme should hold that type of paper. So an element of security is always imbibed there.
Okay. So for a retail investor, a corporate bond does have its fair share of complexities, because firstly the problem is that they have a large ticket size. You cannot just, it's not like an SIP where you can sort of invest only 500 rupees and you can make the investment. It does have a large ticket size, and that's all the more the reason why usually HNIs do tend to sort of make investments at corporate bonds, pardon me. And additionally, it's difficult for a retail investor to also sort of time the market, because there's a lot to do with interest rate fluctuations as well when it comes to corporate bonds. If we had to just, like we said, right, Kalpesh, that in that quest for extra alpha, one does tend to look at products like these. So if we had to talk about, and companies often offer FDs as well, corporate FDs. So if we had to pitch corporate FDs, corporate bonds, bank FDs, what would be sort of your pecking order?
Yeah, so, we always talk about diversification, and like you rightly said, probably corporate FDs come absolutely at the bottom of the ladder, followed by the corporate bonds or the debentures, non-convertible debentures, and the debt funds, and your conventional bank FDs. So it's like a bouquet which you make in your fixed income portfolio. But if you were to ask a pecking order, I would say that first and foremost, you could have your debt funds, which is part of your asset allocation and also tagged towards some of your financial goals to be on the top. Because debt funds, if chosen discreetly and linked to your time duration of your goals, I think are very, very efficient. But you need to select debt funds with the guidance of an advisor. Don't do it on your own. So the DIY concept would not apply there. And in debt funds, surely stick to the AAA short-term corporate bond fund category, or in some cases, the banking and PSU categories. So that has got that 3 to 4 year time frame. And also in the taxation aspect, if you see 3 years and above, we all know that it's the 20% with indexation which kicks in. So debt funds could form a major part of your fixed income portfolio. Obviously, your bank FDs need to be there. You cannot, shy away from that, because that is where you breathe easy. You have the liquidity and security always paramount importance. So whatever amount you feel comfortable has to be placed in that bank FDs. And again, here I would like to make a remark in quality banks. The reason being, we've been even seeing, accidents happening in banks also. So don't search for that alpha in placing a bank FD at least, and place it in the topmost 3 to 5 banks in the country. And finally, we follow it by the corporate FDs at the bottom of the ladder, a limited exposure. And here also, very, very specifically in AAA rated companies only.
You made a very valid point when you said about picking a quality bank as well, because unfortunately we have seen incidents happen, particularly in the corporate, banking space, PMC Bank, Madhavpura, so on and so forth. So don't bother looking around for the extra 0.4% or 0.5% really. Stick to the big names, the quality names, SBI, ICICI, Kotak, so on and so forth. Okay, let's talk a bit more about corporate bond funds. It's a mutual fund within the debt fund category. What are the benefits of a corporate bond fund that essentially eliminate all the disadvantages of a corporate bond?
Question. I think in today's times, people need to understand, what's the benefit of doing this. And here I would say that the most important part is it's managed by experts. And we now know that managing debt is in fact more difficult than managing equity, because the type of, pitfalls and the type of environmental hazards which are there, the economy has to be monitored. There are various things to be seen, and it's best left to experts to manage a debt fund. Secondly, there is a lot of transparency. You have the fact sheets, the changes which are happening in a debt fund, what the fund bought, what the fund sold, the quality, the credit rating, and all that aspects are very transparent through a fact sheet. It's available before you invest. The other important aspect which scores over directly going into buying corporate bonds, which is not everyone's cup of tea, is the the minimum amount which you require to invest in these corporate bond funds is very less. So you can have as much as 5,000 rupees and you start your investment in corporate bond funds. And it's flexible. You can do SIPs, you can stop SIPs, and you can make that corpus in that corporate bond fund your investment. Third is choice of selecting the suitable schemes, because not every scheme, although there is a mandate given of holding AA plus rated papers more than 80% in a scheme, there is a choice of selecting the suitable schemes which are advised to you or suitable to your financial profile. Then the ease of operation and management. Today, everything is digital. You can buy, sell at the click of a button, and the money is credited into your account, within one working day, being a debt fund or something. So I think there are many aspects to it. And the important part, uniform to all mutual funds, is the liquidity concept. You can get your money whenever you want at the prevailing NAV.
Yeah, I think that as well is a very important factor. There's liquidity as well in a corporate bond fund that definitely does give it a big edge compared to, investing directly in corporate bonds. Not to mention that you do not need to deal with all of the complexities about timing the market, so on and so forth, when you essentially are investing in a corporate bond fund. So, there is an expert who knows the ins and outs of the fixed income market very well, and he or she will be the one really who will be taking care of all of that. Kalpesh, in your earlier answer, you mentioned banking and PSU funds. You mentioned gilt funds as well. And you mentioned that about how these as well are good investment options within the debt fund basket. But before I go to you on that, for corporate bond funds, how much should one put in corporate bond funds? Because again, like you mentioned, they do have that little bit of interest alpha. So one would be tempted perhaps to put a little more money in corporate bond funds. But what would be your advice over there?
In fact, Mubina, I would stretch it to three aspects which are very important when you allocate money in your debt funds basket. And it depends on your investment time horizon, it depends on your financial goals, and it depends on the overall asset allocation. So I would keep these three parameters for sure, but not to put any particular amount or something, but the percentage, I would at least place it 15 to 20% higher than putting money in a bank FD or a corporate FD. So the proportion can take shape accordingly.
Great. Finally, banking and PSU funds. Kalpesh, you alluded to that first, but I mean, we often say that investing in a thematic fund may not be the best idea. And when you name something as banking and PSU debt fund, it essentially does say that, look, it's a thematic fund because it invests in banks and PSUs. But why is this different? I mean, why would you, say that, okay, this should be a part of someone's debt fund portfolio?
Today we are talking about all the debt funds which are considered to be in quotes safe. So PSU Bank, Gilt, and corporate bonds are in the little bit of a safer zone category. So continuing that thing, corporate bonds, the PSU Bank name itself, I think, lends a little bit of cushion to the ears of the investor. The primary fact here being that the investments will be almost 80% in government PSUs, and the remaining is obviously in banks, or any mandate is not particularly given here. And one more good part going for the PSU bank funds, like the corporate bond funds, is that they are good for a 3 to 4 year investment time horizon. And more importantly, that the duration in this is not very long. Unlike gilt funds, I'll come to that. But it is a 3 to 4 year investment time horizon, suits that short to medium term time frame, and backed up by the government PSUs, 80% of it constituting. But here too, there's a small caveat which you need to add up here, is that again, please do a little bit of deep diving into these PSU funds as well. Because many a times we find that some PSU funds which the government is funding or the government's project is going on, might be in a standstill for any reason. Like we have a pandemic right now, so some projects which the government has funded or it's a PSU undertaking might not be working functionally, and thereby it could cause a domino effect of a problem. And secondly, in the PSU, in the banking part, please be very careful because there's no mandate given on the credit rating. Many of the banking, bank funds have these 81 bonds, which have been very, very treacherous and dangerous of late, and have been causing great damage to many schemes per se in which they have invested because of the problems they have faced. So these type of schemes need to be, seen with a microscope and seen very, very in detail. But overall, PSU bank funds have delivered well. You have to do it with discretion. And finally, the Gilt funds, obviously, as the name is, it's a government security and very good for a long-term perspective. And in a falling rate regime, in the last 1 year, we saw that the interest rates have fallen. These funds have tremendously benefited, but they can be volatile as well. And that can throw a lot of investors off track. So if your time frame is for the long term, you can have some portion in your Gilt fund because their security is never an issue. It's government backed. Only thing you have to live out the time, you have to stay invested for the long term. 5 to 10 years is an ideal horizon for a Gilt fund to be remaining invested in.
All right, and Gilt funds, what's causing this? I mean, yes, it's understandable why people would be wanting to invest in Gilt funds, as is clearly evident with the way people have constantly been putting in their money in Gilt funds month after month. But what's really leading to double-digit returns from this category for the last couple of years?
So see, one thing is obviously that the government has reduced, the RBI has reduced rates a lot. And that has, we know there's an inverse relationship in the debt fund categories. So that has played a major part in these, long-term Gilt funds giving almost, they've given 10 to 15% type of returns. And that has been a major attraction for many, many retail investors to get in, put in, pump in a lot of money, and a lot of purchasing has taken place. But I don't think that's the right way to approach Gilt funds. And many people have just looked at the returns, the fact sheet, and said, okay, this is the most happening fund, this is the most lucrative fund, and they've gone into Gilt funds without understanding the real detailing of a Gilt fund. So I think put all these together, people have given it more attention, although it deserves more attention if you have a long-term horizon. And we have seen the returns going up. But in case of a reversal of interest rates, I think people could be caught, napping.
Okay, all right. Well, there you have it. Everything you need to know about corporate bond funds. And yes, it may not be the most prudent thing to invest in corporate bonds directly, purely because firstly, they demand such a high ticket size. These are not small ticket items where you can, just like an equity SIP, be done with 500 odd rupees or 1000 odd rupees. It goes into lakhs. Liquidity as well could be an issue. You could expect your money to be locked in for some time. Corporate bond funds in turn do tend to solve most of these problems, and not to forget, it brings on board an expert as well to manage the monies over here. So you do not need to worry about all of this. You can liquidate your money or your investment wherever you want. And all of those complexities with respect to timing the market, timing interest rates, etc. is all obliterated. All right, well, there you have it. That's everything to know about corporate bond funds. Well, let's take on board your questions and queries then. Remember, folks, we are always, ready to answer your queries every day at 5 p.m. here on The Money Show. You can write into us on The Money Show at etnow.tv. Let's take on board our very first question from Har Amrit Singh. He says, I'm 43, I'm a government employee, and I have the under the NPS scheme, 2 daughters aged 8 and 15, salary is roughly 11 lakh per annum. Wife is in the private sector earning 3.5 lakhs per annum. Target is 1 crore rupees by my retirement year, that's 2040, so 20 years from now. Now he's got 5 equity funds and 3 liquid funds, and apart from that he's got 5 to 6 LIC policies as well. So there's HDFC long term and top 100, ICICI Prudential long term, SBI blue chip, SBI focus, so all large cap funds, and then there are 3 liquid funds from Axis, HDFC and SBI. He wants to know if he should open a demat account. He wants to know, oh, and additionally he's also paying down his home loan, which is roughly 17,000 per month. He's got around 6 years to go for the closure of the loan, and the cost of the house is around 35 lakh rupees. Alright, so he's got 2 daughters, 8 and 15, but I think at this point of time he's mostly investing probably only for his retirement, which is 20 years from now. Kalpesh, firstly, he has a 1 crore rupee target by his retirement. So I'm not sure if firstly this is he's expecting to earn this purely from these SIPs, and he's got some other money parked in other places like NPS, etc., but that's the only thing he's mentioned. But do you think 1 crore is a sufficient amount really for for your retirement, because he'll retire when he's 63, and God willing he'll have a good healthy life, he has a wife, he's got 2 daughters as well. Do you think that 1 crore will be a sufficient amount? And of course if you could share with us your views on his funds.
So rightly said, Mubina, that whenever we set a financial goal for the future, the one biggest ally you have to consider along with you is your inflation. And I hope this gentleman, has considered, but I don't think that's a part of the figure of 1 crore. Otherwise, it would have, been a lot more than the 1 crore which he expects, because considering his income, his lifestyle and all, I feel it's going to be far, far more than what he's looking. So please consider inflation on a futuristic basis whenever you are planning for your retirement or your children's higher education and so on and so forth. Secondly, going by a point-by-point response, he has too many liquid funds. You don't require 3 liquid funds or, 1 ultra short and 2 liquid. You just need to have maximum 1 or 2 to suffice for your contingency fund or a short-term goal. Secondly, in the funds which he's mentioned, the schemes, he can add a mid-cap. I would recommend DSP mid-cap to be added to that with a long-term view, and he has a long-term view. Other equity funds he's selected are fine. He's got the large cap and the multi-cap and all those. So that is fine. He needs a monthly SIP of approximately 24,000 rupees. He's not mentioned the amount which he's putting in, but 24,000 would get him to 1 crore, which is less. And this 24,000 is calculated if it's growing at a 10% CAGR. That's part of the goal planning. And considering his insurance, he's mentioned, I hope he has adequate health insurance for himself and his family. And, considering these terrible times we are living in, health insurance is paramount. And his 5 to 6 insurance policies, I'm sure they're all endowment plans. And I pray he has 1 term insurance plan. If he doesn't have, he needs to do that on priority. Get an adequate term insurance for yourself, and approximately, considering his income, a minimum of 1.5 crore could be necessary for him. And he's also got a home loan, so term insurance, needs to cover that as well. And demat account is discretionary. If he needs it, he can open one. If he doesn't, that's fine. But more important for him is to rework his retirement goal target.
Yeah, I think he's missed out on the insurance component, and Mr. Singh as well has not mentioned anything on insurance, so that's extremely important that he's adequately covered. Though he has said he's got a couple of LIC policies, but he's not really elaborated on that. I'm hoping that one of them is at least a basic plain vanilla term insurance, because that sometimes can just really do the trick. Okay, let's take on board our next question. It's coming in from Dr. Rajan Kurian. Dr. Kurian writes saying that I'm a 48-year-old NRI. I have an NRI FD investment since July 2019 of 25 lakh rupees, which matures in July 2020. Now, he's got 4 SIPs as well going on, where in fact he invests per week. So there's DSP Mid Cap, Motilal Oswal Multi Cap 35 and Motilal Oswal Small Cap Index Fund, where he's putting 4,000 per week. And there's the SBI Healthcare Opportunities, where he's putting 3,000 per week. I will say in the last one, he's definitely minted a lot of money, most of it I'm sure in 2020 itself. So the total mutual fund investment stands at 17.5 lakh rupees, sitting on a gain of 10%. And he's also got 10,000 rupees lump sum invested into each of the funds between 6 16th to 23rd March. I think he took advantage of the fact that the market had fallen quite a bit. So total is now 42.8 lakh. He's got some cash of 15 lakh. He's got Nippon ETF gold as well, bought at 24.68, and that is now gaining at 42%. So he wants to know, should he add or reduce any mutual funds? What should be the strategy to maximize his nest egg by the next 10 years? Well, Kalpesh, he's bought a pharma fund. He invested when the market was down between 16th to 23rd March. And moreover, he's got a gold fund as well. And all these three investment strategies have really been very smart ones and the most beneficial one for investors so far in 2020. But anyway, what is your advice on how Dr. Kurian could go about, further reaping the maximum from his portfolio?
So, Mubina, this Dr. Kurian seems to be a better investor also, and a very good doctor, I'm sure. So he's done a fabulous job as an investor, and he's ticked almost all the boxes. And I'll just give some finishing touches to it to take on his excellent calls which he's made. So first of all, he's mentioned that he's got some NRE Bank FDs which are maturing. So I think what he should be doing is maintain his asset allocation. Because that could be his fixed income component in NRE Bank FDs, and Bank FDs for NRE are a blessing even today with the reduced interest rates because they are tax free as on now as we speak. So continue investing in them. Please, you can keep on renewing them, and you don't have any better option than NRE Bank FDs because with the tax element, you're still a healthy 7 to 8% type of a thing if you're in the highest tax slab. So maintain that asset allocation, renew your NRE Bank FDs. Regarding the equity mutual funds, spot on, you're on the right track, which you've chosen. Just one thing here, you can add an index fund to, join the large cap part of your portfolio. You don't have a pure large cap fund. Everything is a little bit on the aggressive side. So a simple index fund for the long term would do for you, which will give that large cap flavor. Although you've made a call of investing in the healthcare part, healthcare fund, which is a thematic fund, and it's presently done very good for you. A bit of caution here is necessary that you need to monitor it very properly because in all thematic funds, it's a concentrated holding and no retail investor knows the right time to enter or exit. So you need to be very careful about the healthcare fund, and these are all a period type of investments when you invest in a thematic fund. Be focused. You need to be focused on your long-term goals. Set financial goals. Name your goals. That will keep you more disciplined. And earmark your investments which you make. Link them to the respective goals. That will help you focus and align your investments. And strategy to maximize your nest egg is to maximize your investment amount as your income and profession grows. So, and that too in equity mutual funds, keeping your asset allocation in mind.
All right. Well, while you're doing very well on the investment front, you need to ensure that you have investment objectives kept in your mind. You haven't listed them, but I'm assuming you're obviously a long-term investor because you've been investing in these funds as well since 2017 and 2018. But it's good to have an objective in mind as to why you are investing. Okay, well, great. With that, we're out of time. So I think that's all the questions we'll be able to take today. Like I always say, don't worry, keep writing into us on the Money Show at etnow.tv. And Kalpesh, it was a pleasure having you with us. Thank you so much for joining in.